All right, let's just jump right in. Why if you could own a piece of your favorite companies, the ones you use every day, without having to start a business yourself? That's the real magic behind the stock market. But I get it, for so many of us, it feels like this super complex, insiders only club. Well, over the next few minutes, we're going to change that. We're going to demystify this thing once and for all.
Seriously, forget about all the headaches of building a factory or launching an app from scratch. What if you could become a business owner, like right now, just by buying a tiny, tiny piece of a company that's already up and running? It sounds pretty powerful, right? Because it is. But, and this is the important part, to actually use that power, you've got to understand how the game is played.
Because at its absolute core, this is all that's happening. When you buy a stock, it's not just some blip or a number on your phone screen. Nope, you are buying a literal piece of the puzzle. It's a genuine slice of ownership in a real, living, breathing company.
Okay, so let's really get this fundamental idea locked in our heads. What is a stock, really? It's so much more than a number on a screen. It's not just some chip for traders to play with. It's a real claim on the future of a business.
Now, let's look at this definition a bit closer. See, it's not just about ownership. The really important part is that you have a claim on the company's assets and earnings, and that is the key. It means you're literally tied to the company's fate. You're in it together. You get to share in the successes, but you also have to share in the risks. When it thrives, you can thrive too. But if it stumbles, yes, so does your investment. So that brings up a really good question, right? Why do stocks even exist? I mean, why would a company, especially a successful one, want to sell off little pieces of itself to strangers? Well, it all boils down to one simple, powerful word: growth. And to make this crystal clear, let's just tell a quick story. Let's meet Emma. Emma is an amazing baker, and she has a dream: to open her own restaurant, Emma's Kitchen. She's done the math, and she knows she needs $100,000 to get it off the ground. The problem? She only has half of that. She needs to raise some money, some capital. So Emma's got two main options here. Path number one, she could take out a loan from a bank, but that means debt, paying interest, and this constant pressure to make those payments. Or there's path number two, sell ownership. By creating stock in her company, she can find partners, investors who believe in her vision. They share the risk with her, and in return, she gets the money she needs without going into debt. She decides to go with path two and bring on some partners.
Okay, and this little story perfectly illustrates the journey of an investment. So let's follow one of those shares she sold and see exactly what happens to the investor's money. Because this is where you see both the exciting potential for profit and the very real possibility of risk. So, Emma decides to divide her whole business into 10 equal shares. To get the money she needs, she sells 5 of them for $10,000 each. And this is where Daniel comes in. He absolutely loves Emma's idea, he believes in her, so he invests 10 grand to buy one of those shares. Just like that, he owns 10% of Emma's Kitchen. He's officially a part owner. Okay, now let's fast forward a couple of years, and the news is good. I mean, really good. Emma's Kitchen is a massive hit. People love it, profits are soaring, she's even opening up new locations. The business that was originally valued at $100,000, it's now worth 3 times that. So what does that mean for our guy Daniel? Well, he still owns his 10% share, but now his 10% is of a much, much bigger pie. His initial $10,000 investment is now worth $30,000. He didn't have to bake a single cupcake, but because he was an owner, he benefited directly from all of Emma's hard work and success. But, of course, every investment has 2 sides. Let's rewind. What if the story went the other way? What if a new competitor moved in across the street, food costs went through the roof, and profits started to drop? Well, the value of the entire business would take a major hit. In this not-so-great scenario, let's say the value of Emma's Kitchen falls to $80,000. Well, Daniel's 10% share is now only worth 8 grand. He lost money. And that's the crucial point to remember. Stocks are not a guaranteed win. The value goes up, yes, but it can absolutely go down too. Emma's Kitchen is a perfect little example, but what happens when a company gets huge? I mean, really huge, and it lists on a public stock exchange, like the New York Stock Exchange. All of a sudden, you've got millions of people buying and selling its shares every single second. So what on earth makes those prices jump up and down so wildly?
Well, the answer isn't as simple as just looking at last year's profits. The day-to-day movement of stock prices, it's driven by something way more powerful and way more human. It's all about what people think is going to happen in the future.
So, what exactly fuels these expectations? Well, of course, the hard numbers matter. Things like profits are super important. But so are the big picture ideas, you know? What are the trends in the industry? What's the whole economy doing? And maybe most importantly, raw human emotion plays a huge role. The market is constantly swinging between collective greed and collective fear. It's basically a giant marketplace of belief about what's coming next. Okay, so now that we've got a handle on the what and the why, let's switch gears and talk about the how. If you're just starting out, how should you even approach this whole thing? Let's put together a simple little playbook.
Fundamentally, there are two main ways you can make money in the stock market. The first one is called price appreciation. That's exactly what we saw with Daniel's good scenario. You buy a stock and you sell it later for a higher price. Simple. But there's a second way, dividends. You can think of these like a cash bonus. Some big, stable, profitable companies will actually share a slice of their profits directly with you, the shareholder. They'll just send you a payment just for being an owner. And it is absolutely crucial to understand the difference in mindset here. You've got traders and you've got investors. A trader is trying to play the market, trying to profit from all the short-term ups and downs. But an investor is buying a piece of a business. They're focused on the long-term health and growth of the company, and they often hold on for years, maybe even decades. They're not stressing about tomorrow's price. They're thinking about the company's value 10 years from now. So if you're just getting started, here are 3 golden rules. First, diversify. It's the old saying, don't put all your eggs in one basket. Spread your money across many different companies to protect yourself. Second, think long-term. Time is your superpower here. All the daily noise from the market is just a distraction. Focus on the big picture. And third, and this might be the most important, learn first. Never, ever invest in a business you don't actually understand. Knowledge is your absolute best defense against making a bad decision. Because here's the ultimate takeaway, the thing I really want you to remember. The stock market is not a casino. It's not about gambling or just getting lucky. It's about patience. It's about logic. And it's about having the discipline to really understand the true long-term value of the business you are becoming a part owner of. And maybe, just maybe, the most important thing of all is that it's about learning to trust your own research instead of just following the noise of the crowd. It's about having the conviction to think for yourself. And let me tell you, that is a skill that pays dividends in way more than just the stock market.